Hello, welcome, and thank you for joining us. Hey, of course, these are my opinions and my opinions only. It's not the station, any broker-dealers, any of that. That's it. And we're not here to buy, and sell, and crazy stuff like that. We're here to talk about our own emotions, our own feelings of how we invest, and the importance of money in all of our lives, the importance of fighting fear, all of those things that ultimately determine more than picking the right investments, how you actually do. And the idea of making noise and trading and things like that may be exciting. It's like, betting on a flip of a card or a roll of a dice. But that's not what we do. That's not what serious money ever does. In this world, it's easy to create multi-generational wealth over time. And it's also true in this world of instant gratification. It's extremely hard to think about over time. We just think about and get involved in the day-to-day. And why not? It's right in front of us. It's on every screen we look at. Even that thing we sometimes, incorrectly, of course, call a telephone. Because it's really a computer, it's a connector, it's everything. And also we can talk to other people on it, or we can do video with it, right? We can do FaceTime. All these things are amazing blessings and have changed our lives, but not in the most important way in my mind. You are free to get completely fussed up about things that probably never bothered you much before, or wouldn't have if it wasn't on the 24/7 loop. I better go and check and see what's going on in Europe overnight, disrupting your sleep, disrupting how you feel about everything by pushing the button and getting more information that not that long ago really wasn't available. And then the pounding of the media, 24/7. Boom, boom, boom. We're all going to die. Market's super volatile. What are we going to do? And we're drawn away. Now, I want to start this a little bit and get into some charts and stuff that Jennifer Stone at our office that has been, Jennifer and I have been working together for 27, 28 years, something like that. She's fantastic. Done a great job. Certified Financial Planner, all that stuff. And runs our office. Sent this out on Monday, and it really, to me, says, it doesn't say it all. Maybe it says it all because it's so brief. Let me open this hour with this. Stay the course is the title. Stay the course, of course. Sounds simple, doesn't it? However, sitting on your hands is never an easy thing to do. Investing requires discipline and not reaction. It requires sticking with the plan that was designed to meet your objectives and not changing it based on current conditions. We understand the concerns of today and how the feeling of this time is different, maybe starting to creep in. Remember, there always are events and concerns. We just have moved past the ones, we've solved the ones in the past and moved on. We have and always will stay the course. There's a few things attached to this, and the reason I bring this letter up too is because it's brief, it's to the point. Why can't we sit on our hands? What is the matter with us that we can't? Why do we do this over and over again and expect different results? And I don't know that I can answer that except to call it something broad like human nature. And we'll dive into some of these things about why it's so important. I opened the last hour by talking about the average investor getting 2.9% the last 20 years per year in a market that did 7.5%, in a market that bonds did over 5%. Bonds. We are our most destructive creatures. We decide that we know because of a parade of the big box showing us, telling us every moment of every day how it's not going to end well. And we think we're being rational when we say, I'll just go ahead and go to the sidelines for a little while. And it's over. It's done. You are now relegated to the world's worst investment people pile. And it's a big pile. So you'll have a lot of company in that. And I know, there's a lot of reasons why you're going to justify it. But there's this, but there's that, and I'm coming back. I know this works. I know a cup of coffee for 40 years, $5 a day is $1.1 million. I get this works long term, just not for me right now. It's over. It's over. And we just don't know it. Because now you've entered the dark side. You've decided that you are going to be a market timer. I'm not timing the market. I'll come back. I'm just going to be right back. Or, here's a great one. How many times have you said this to yourself if you're over age 65? Hey, we're just too old to go through another 08. Have you said that for the last, how long was 08 ago? Have you kept saying that? I know I hear it all the time. Long term is not for me. Okay. But it is, or it seems to be, long term is for you when we have no other alternatives. Like, let's put it in the bank and lose 5% a year to inflation. That's not a plan. That's ludicrous. I know. Let's pay 10% commission, put it in an equity indexed annuity because it's guaranteed. Guaranteed not to work. Straight up. Now, they don't have to disclose that. Don't worry. They're not actually licensed financial advisors because they would have to have the disclosures in it, in anything they do. Anything you do. So when we talk about things like staying the course, and we talk about the volatility that's natural and normal and certain to occur over and over again all the days in our lives, then why do we collectively as human beings freak out when that happens? I don't know. It's interesting. The smartest people are often the dumbest people. They really are when it comes to investing, because we don't acknowledge that this is a game of emotions. Not wit. Not picking the best investments, not the smartest ones. Sure, I know more stuff than you do. I've been doing it for 40 years. I have some things that are pretty cool on the side and over here, but I don't know what the future is any more than anybody else. I don't know what the next thing that's going to hurt the market is until it happens. How many times have you heard everybody talking about with such certainty that they know it's going to be inflation, it's going to be raising interest rates. When this happens, that happens, da-da-da-da-da-da-da-da. And there's sometimes you go through the most amazing thing. What if we went through a pandemic? Well, and unilaterally, the world just shut down. We ruined supply chains. Inflation became a problem. They just threw money out of helicopters at everybody. And millions of people died. Well, you would know for absolute certainty that the market would go down, but it didn't, did it? See, even if you know things, you don't know what the reaction of the market will be to that. So when we talk about staying the course, or absolutely to occur over and over again all the days of our lives, market corrections, and yes, not just corrections, bear markets. I counted them up since my 40 years. I've been through 6. That means 20% or more declines. The average is around 30. 6 times since 1980. And the Dow has gone from 800 to 35,000. With those included, it's part of the game. We know it's part of the game. You know it's part of the game. But what happens then, because you're a human being, is when it happens, we look at the news and we zero in. You know, I think instead of watching merely 4 hours of garbage heaped on me every day, but that's okay because I can handle it, man. I can handle it. I can handle endless streams of bad news, 4 hours a day. But see, I limit myself. I only take 4 hours a day. Unless there's, of course, a crisis, then I really hone in and I spend only 6 hours in front of 1 or 2 or 3 different boxes. I mean, I do have to go shopping once in a while. So, but at least I can take my Sirius radio and listen to all the bad news on the way to and from. And then, of course, I can take the thing they call a phone, and we can turn it on, and we can have it follow us around with bad news all the time while we work out. All of those things, because that's going to make sure that I have less clarity of the world and more certainty it's all bad and all going to end soon. And then I can react emotionally to my investments. I don't think that's anybody's plan. But it's what people do. It's human nature. The average drawdown per year. Now, what does that mean? At some point, the average drawdown, meaning if the market goes up 10 and then it goes down at some point in time, the average per year since 1980, by the way, a fairly substantial amount of time, is 14% a year. Now, what does that mean? That means some years you've only fallen 5%. The market just kind of steadily went higher, steadily moved its way up. Sometimes we have a catastrophic drop, like in 08, when it went down 49% from the high of the year to the lowest point, that percentage drop. We didn't drop that much for the year. We dropped 38%. Not exactly a good year that year. But on average, it's 14% every single year for the last 41 years. On average. But when you think about, we just had a 10% drop in the S&P 500. What does it feel like? Does that feel average and normal to you? Doesn't it feel like with all the news and everybody screaming and yelling and talking about it and us constantly blinking at the box, that it's way worse than that? We've never seen anything like this. And always with different people and different news and different things, we never have seen anything like this. It's true. So it's easy to convince ourselves that this time is different because every time is different in some way, shape, or form. And the future is, well, it's unpredictable. I know you think you can predict it. I know the guy on TV's predicted 6 of the last, 160 recessions. Why? Because they predict it all the time. And so when they're right, like a stopwatch, the hero is paraded around as a soothsayer and a great seer of the future. Just send $300 a year, and we'll put you on our subscription so you can catch the next one. Marketing schemes everywhere. The certainty of our own, it's all unsure. It is so unsure. And it throws us off. And particularly important in this time, where stocks always win. And you know, hey, if you've listened any time to this program, you know how fair I am. I mean, I'm serious about this. I am totally 100% serious. We do not come out here and cherry pick numbers. I don't ever do that. I mean, never. In fact, I show you all the time. Here's why you can't believe anybody about the last 5 years, because now we're getting on this really down time, and it's going to show all of these mutual funds and all these investments being the greatest thing in the whole wide world forever and ever because they did 25% a year because it's measured from the bottom in 08, for example. We want to go back to a really bad time. Like, how about the peak of investing in 2007? How have we done since then? Not the bottom of 08, 09. We want to do that. We want to take a very volatile fund and talk about how in the long run, even these aggressive investments that have gone down, let's call it 15 times, they have more than 20% corrections. Why? Because they're full of tech stocks. but their average returns are so much greater. We want to show the bad. Does it still work out? Yes, it does. We want to talk about long periods of time, like your lifetime. If you're not spending all of your money, why would you invest like you were? Keep investing it for future generations or the charities you're going to give it to. Of course, being safe and making sure and all those things. But when we talk about a 14% average correction, which can be as high as 49% and as low as 3%, but always we have drawdowns. Always. And as we look since 2007, this may surprise you, because in 2007, it was so bright you had to wear shades, right? I mean, it was amazing. Everybody, just go ahead and get some loans, buy some real estate, it's going up. Everything was working and everyone was confident. We know what happened. But I want to talk about these returns from the market peak in 2007 and the disaster, which was a 50% sell-off in the U.S. stock market in 2008. Stocks are now cumulatively up from the peak in 2007, after right out of the chute, 50% drop, another 30% drop in 2020, are now up well over 300%. 300%. You may ask about things like gold, a 10-year treasury. How about the consumer price index? Home prices, of course, because it's red hot. I could have parked in cash and done really well. How about oil? Oil's down. Literally, cumulatively down. 10-year treasury earned 4.2, not bad. But stocks, even going down 50% right out of the chute from the peak in 2007, are up 10.6%. Per year, compounded. Nothing is even close. Nothing is even close. And measured from the high, not the low. An honest assessment. History's on the side of stocks. It always has been. But if we don't stay the course, we don't hang in there, and we think about this from this perspective too. Look, you think you can time the market. I get it. Step to the side. Don't worry about it. It won't cause any psychological damage to you. It won't. Don't worry. It doesn't bother you. You're okay. Other people, I get it. Right. They only get 2.9% because they're so bad. But I got this, and it's only a one-time thing, and it's all right, and it won't psychologically impair me. Look, one more thing, and then I'm out. Over the past 20 years, and I've done this over and over and over, I want one more look at this. If you were fully invested in the market, 8% plus, over 8% return. Fully invested, the good, the bad, and the ugly. But if you miss just the best 30 days, this is a 20-year period, 100% of your gains are gone. 100%. You are now losing. It's a negative return. And honestly, if you only missed the 10 best days, your returns are cut in half. Here's one more piece. Because some of you are super smart. And you're going to get, yeah, but what if I missed the 10 worst days? Sparky, what if I missed that? Well, here's what you need to understand. 6 of the 10 best days, 6 of the 10 best days occurred within 2 weeks of the 10 worst days. You think you're going to trade that? You stepped aside, then you got back in, got that big day, got back out. No, you didn't. Nobody can trade like that. And even on a shorter term basis, are you ready for this? I mean, this is really remarkable. When we have had our worst extreme down days, okay? And by the way, we've had a few of them recently since the pandemic. They make the top 20 of all time. 1, 2, 3 times are in 2020 alone. 1 year later, there was only one time in 2008 when we had a 9% drop in a day. The market was down 4% a year later. Do you know what the average is? Up over 30. Up over 30. It's pretty amazing. The 15 largest down days that ranged from 20%, over 20% in 1987 crash, down to just under 7. And of course, the 3-year, the 5-year, the 10-year are all positive. 100% of them. Only 1 year was -4 a year later. That's what you miss when you step aside. You miss for no reason that the market on Thursday turned around. It was down 3.5% on the NASDAQ. About 3 on the S&P 500. And closed higher on the NASDAQ by 2.5%. Why? It must have been some news. And I'm sure if you were watching business news, they gave you a reason. And it wasn't something like, hey, market just ran out of downward momentum. That's it. All over. All done for the day anyway. Was it because Russia suddenly pulled out of Ukraine instead of rolling across? No. Was it because interest rate? No. The Fed? No. Joe Biden? No. No. None of the above. So in other words, the news item that turned the market around was non-existent. There was none. It just happened. And then yesterday just happened again. With hundreds of points on the Dow and another couple percent on the NASDAQ. Out of nowhere on bad news. Remember that. Markets just go. And then when they run out of momentum on the upside or downside, then they just go. There is no news. But there's a hound of people out there called the media just babbling about it. Babble, 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 babble. Here's the reason why. Babble, babble, babble. Like we ought to be trading every day. Like oil went up, oil went down. Oh my gosh, we should be trading. No, you should be owning the great corporations of the world. That's why it's important to understand who we are, what we are, and to stay within yourself. Don't chase. Dial down the noise. And try to sleep well. So that you have clarity. Clarity of what's worked your entire life. And we stay the course.